panel is about market review and price outlook. The moderator of the session on the stage, Mr. Philip Newman from Metals Focus.
First of all, my thanks to Fortel for inviting me to chair the session. My name is Philip Newman. I'm one of the co-founders and directors of Metals Focus in London. And I'm very privileged to welcome the panelists that we have today. First of all, Bart Melik, who is Head of Commodity Strategy at TD Securities. Next to Bart is Sudheesh Nambiath, who is a lead analyst for precious metals demand at Thomson Reuters GFMS. And then finally, someone I think perhaps needs no introduction, Debajit Sahar, who is the editor of Bullion Bulletin. So welcome to you all. So I will start by making a few comments on the global silver market. And in fact, today we have, I think, quite an ambitious objective. In the next hour or so, not only are we going to try and give you an idea of what's happening in the global silver and gold markets, but also give you a sense of what does that mean for India. So what is the outlook for the gold market here, and also silver as well. So let's just crack on. So really a slide that many of you will be familiar with, historical spot prices. And the reason I put this up here for silver is just to really remind everyone, and this applies to gold, is that it was only really just a matter of 8 months ago that we were still very much in a bear market that had lasted for 3 years, and really how quickly times can change. And the reason I put on here the smooth blue line, which is the 100-day moving average, if you look at it for 2015, whenever silver briefly tried to establish some upside, some momentum, investors were coming in and they were selling into that and they were liquidating. And I don't think it's too much of an overstatement to say that last year there was almost, I would say, outright disdain by professional investors towards parts of the precious metals complex. And we contrast that really quite heavily with what's happening in the retail side. And I'll come back to that in a moment. So as I mentioned, we've had some very nice upside for silver this year, rising by over 40% year to date. So why is that? Well, are there any clues in terms of the supply demand that we can perhaps learn from? So the first one really, this is a sort of a 30,000 foot view of global supply. The grey bars show you our 2015 and 2016 estimates. The numbers in between are the year-on-year changes. So as you can see, for hedging, for recycling, for the government sector, for silver, very benign, very little change. But the important one is really the mine production, which is down about, our views are down about 2%. For 2016, so you could argue that could be providing a little bit of price support this year. But the key thing for this is that mine production last year achieved a record high for silver. So even though we're down 2%, we're still very much operating near elevated levels. What are we seeing on the demand side? Let me just walk you through these then from left to right. So the 2015 total on the left of about 33,000 tonnes. We then have a nice increase for industrial, whereas for jewellery, silverware and photography, not much of a change year on year at the global level, so not much impact from a price standpoint. The important bar, if you can see, which is the big thick red bar, shows we've got a quite large decline for bar and coin demand this year. And in fact, as we produce our next 5-year silver report, I would expect that to show a much larger decline. So what do we see? The reasons for the physical demand weak, one is because of India, and I'll leave Sudheesh to cover that later. But we also see a very weak US market. So in the States, we're having very weak sales of Eagles, we're having dealer stocks backing up, excessively weak premiums in the US market. It's a very challenging place right now. So far, there's nothing really to indicate why silver prices should have performed as they did. Which brings me to the first of the two key slides, the performance of exchange-traded funds. And if you focus on 2016, what was interesting is that even the beginning of this year, as gold was picking up quite nicely, silver ETFs were still performing quite poorly, as they had done for last year. And in a sense, we had a very bearish sentiment towards China, still fears of a hard economic landing, industrial commodities being sold off, silver behaving as an industrial commodity. How times have changed. Now behaving very much as a precious metal. We've seen the ETF holdings reach record high levels in volume terms, but in value terms remaining very, very weak. And my penultimate slide, staying with the investment theme, and one that will be familiar to many of you, what's been happening on the COMEX in New York. The green area at the bottom is gross short positions. So what we've seen there is those gross shorts have come down as investors have, again, become more positive towards silver, less concerned about material downside this year. At the same time, you've had a massive rise in gross longs, which is shown by the yellow area at the top. That's reached a record high both in volume and essentially in value terms as well. So perhaps my most important slide today, where do I see prices heading for silver? I'll say my view of 2017 as a whole to the end when we ask everyone. But what we're basically expecting is that for this year, we think we've already seen the high. We had earlier this quarter of about 21.14. Now, of course, silver is notoriously volatile. But we believe that the upside this year will be limited, a high of perhaps around $20 for Q4. But we're still optimistic for both the rest of this year and for the coming years as well. And on that slightly more positive note, I'd like to introduce Bart to give us his views on gold, if you may.
As I wait for my presentation to be loaded I'd like to take the opportunity to thank those of you that have shown up, and hopefully I'm not going to be boring, and I promise I will try not to be as long as I normally am, and I should be done within 8 minutes, I'm told. I think I'm going to start talking, and we'll catch up with the slide. So, as you have heard, I'm from TD Securities, which is wholly owned subsidiary of Toronto Dominion Bank, and we are here in India trying to explore some opportunities for our gold business, and so far I think we like what we see. And it's only fitting that I'm going to start talking about gold. My gold position is actually quite optimistic. We're looking at an average price for the next 12 months of about $1,300 on average, and I'll mention silver as well. Now, this is, I think, from current levels, a bit of a trend lower, but in the final analysis, it's not a bad outlook at all, particularly since we are expecting a monetary policy normalization in the United States. Well, I see my charts are up, and as you see from my fanciful title here, ultra low interest rates around the world will, in my view, very much mute or soften the impact of monetary normalization in the United States. What that essentially means, I'm going to try to translate economist talk to normal people language. In essence, the higher interest rates coming from the United States should not have a dramatic impact on the gold price as we have it now. We do see a correction, but it is important to say that we don't expect a rout. And this is essentially a bit of a demonstration why many people believe that we could have a big correction, as we did in the 1980s when Mr. Volcker, when he was newcomer to the chairmanship of the Federal Reserve in 1980, fought inflation very hard. We had real prices of gold moved all the way up to $2,500 plus, and then drop massively once the US Central Bank started monetary policy, which moved interest rates sharply higher in real terms. In my view, it's not inflation that drives gold. It's not really interest rates on the nominal side, it's really real cost of carry. That is the nominal interest rate ex inflation. So when interest rates move very negatively, there is very little cost of carrying metal. Inventory holding becomes, well, kind of earns you money. To the extent that gold is a zero yielding asset, it will very much behave like a zero coupon bond. And when interest rates are negative in real terms, you have no incentive to get rid of gold. And in fact, what you might want to do is you want to keep these assets to protect you from the devaluation of fiat currency. Now, the question is, why do we think today we're not going to see a drastic correction a la 1980s, which was, quite substantial, and then we had, many years of very low prices. And the short answer is that real interest rates, in our view, are going to continue to be quite low, even in an environment when the US central bank starts lifting interest rates. One, we have very low oil prices, which are generating disinflationary pressures around the world. We are still, believe it or not, recovering from the Great Recession and the massive financial distress that was present. And we are in an environment where the Bank of Japan, the ECB, and the Swiss central bankers are creating an environment of negative interest rates. So when the US moves rates higher, we are still going to see very strong demand for US Treasury instruments because it's still the best game in town. In essence, markets will be looking on a continuing basis for yield. And even as the short end of the curve moves up, we're not going to see big impacts along the entire yield curve. So what does that mean? It means the cost of carry of gold will continue to be low. I'm not saying it's going to be necessarily negative, but it's going to be low. And the Fed and its action should really be looked upon as policy normalization rather than taking restrictive measures. What does that mean? They just want to get off the so-called zero bound in positive nominal territory. The economy still is quite fragile in the United States, and we are not quite sure what the steady rate of interest rates that are neutral is. It used to be, 2-3%. It's probably much lower now. So the Fed isn't going to be very aggressive on taking interest rates higher. And it is this expectation that we think has been driving gold markets ever since the financial crisis. This is why we've peaked after quantitative easing, and this is why we've moved lower after the Fed started reversing, or at least started signaling the reversal of some of that. More recently, we've seen the bond market and the gold market very much react to US economic data and expectations of real interest rates. So I gave you our forecast of $1,300 over the next 12 months or so, but we certainly think that we could see $1,400 over the short to medium run. And why is that? Well, we continue to expect a lot of ambiguity on the part of the Federal Reserve. As of a few days ago, the Fed Fund futures curve is no longer predicting a Fed hike this year. We're only looking at a 45% probability, so it's under 50. Anytime that has happened in the past, derivative positions for gold have moved higher. In fact, back in early July, we've seen the highest level of net speculative positions in gold, and this is what has, in essence, been responsible for the recent rally and the move to $1,400. We expect this to happen again. US data is going to come in fairly decently, but because of continued issues outside of the United States and fears of disinflationary pressures in Europe and Japan, we think the Fed isn't going to pull the trigger. And that, I think, is going to get investors back into gold. Even though we've seen a record level of net speculative positioning and a record level of net longs. Now, why do we think that's possible still? Because as the market expects interest rates to go higher, and if we continue to see economic growth being subpar and potentially weak earnings growth, we are also likely to see some safe haven demand, at least in the short run. So it is entirely possible that positioning on the derivative markets may go overweight again. As you see over there, we've seen every time there is a bit of a crisis, every time there is a bit of a sell-off in equity markets, investors tend to seek refuge in gold. And we certainly expect that to happen in the medium term, particularly if the Fed doesn't move this year, and it becomes quite apparent that it doesn't. Longer term, we do ultimately think that the US Central Bank and interest rates will move higher. But before that, I think we could still see a negative interest rate environment globally. With the Fed, with the 10-year Treasury at 1.5, German bonds yielding, minus 0.1, the Swiss almost negative 0.62. We are not going to get interest rates moving gold into the market. In essence, current stockpiles and inventories have no reason to get out of there, which is, not a bad story for gold. And at the same time, if we see those interest rate differentials between the US and the rest of the world kind of narrow, it is very likely that the US dollar may lose some of its upward momentum, helping gold. And I think I will probably end here and give someone else a chance. So the key takeaway here is we do think that gold will moderate from current levels, but very modestly because of the very, very benign interest rates environment around the world. And we expect an upside risk for now.
And Debajit, can I ask you to say a few words, please, about the outlook for the Indian gold market? As soon as your slides come up.
Good afternoon. Actually, I feel this is very difficult for me to add anything because whatever the issues we are talking about the Indian gold market. And I think all of the issues we have discussed last 2 days, let me try what I can add to the audience. So these news clips actually, this is telling the whole story. We have first quarter demand 116 tons. We have discounts that sold to $32 per ounce. We have Indian gold imports dropped to the lowest level. So all these stories telling what we have in this year in the Indian gold market. What is we can see on the other side, that government will be extremely happy that CAT has come down, and thanks to for this is the low oil price and of course the low gold import. But I don't know whether unofficial inflow of gold which is reportedly around 60 tons, whether it is a big number for the government of India. If it is not, so I have nothing to say. But if it is a big number, it's a concern of economy, I request government please look after this. So before I analyze what happened in the first half of this year, let's see gold savings habit of our people. What we have calculated here, savings in gold as percentage to the total household income. What we have observed that in last 10 years, people of this country have increased their habit of buying gold. What they earned, they have saved from 5% to the tune of 10.5% at present. So what we have discussed earlier in this morning, that someone told the young generation has stopped buying gold, they are spending money in luxurious items. I feel the statement is wrong, because here it is saying the last 10 years we have increased our proportion from 5% to 10%. And what we can proudly say, when the Western experts are recommending investors to allocate 5 to 10% in their portfolio, here we Indians have realized, and we are maintaining a very, very strong balance. So what is another 2-3 things, what we can see in this chart, that jewelry is still the preferred form of buying gold, undoubtedly, and despite a very strong growth in the bar and coins market in last 3-4 years, that has come down. Maybe this is the reason that government has stopped banks to sell coins to their retail outlets. But nevertheless, and also at the same time, what we can observe, last 3-4 years, the jewelry consumption is also stagnant. Maybe our household income has not grown the way it has grown before 2008. But overall it is 10 to 11% that we are currently consuming. Now see, this year what happened? We have projected that we are talking about the unofficial gold a lot, but we tried to understand what was the official supply, what was the jewelry demand, and what actually happened in the market. We compared it with the H1 2015 figure with our estimate of the H1 2016. H1 2015 we have taken the figure from World Gold Council. And what we have observed that in this year, the official supply was far little close to match the demand of the market, and that is why in that point of time gold has been supplied from the unofficial source, or the source we can say is in question. And also what contributed? The destocking of the legacy gold. So in these next charts we will see how it happened. But before that, what happened actually market, that what this chart is showing, the market has gone to deep discount when the excise has been announced. Before that it was around $10. But moment the excise has been announced, so it has gone to $30 to $32. So I don't have to say much more after that, because it is strongly visible that excise has a strong impact this year, and that has pushed the gold market to a deep discount. It may be 2 reasons. What we observe from the market, a lot of gold has been sold. We know in India there is a community-based sourcing happen. The jewelers take into account, arrange money from their relatives and the sources, and those gold has been sold into the market. That has pressured, and at the same time the official supply was there. I hope the excise registration, 30th jewelry was the deadline, it is over, and I believe that this discount may come down gradually. So now what we see that my estimate on the next 6 months, so what we can see, we have made a comparison between the last year and this year. So jewelry consumption in the last second half of 2015, and overall what we can see, the average consumption was 170 tons, and the Q4 it was 184 tons. So together it was little over 350 tons. And what we can observe, the investment was around 48 tons. So what we can say, what we have observed this year, the next quarter, that is current quarter, this current quarter we don't believe there will be a big demand will return. The reason is very simple. Price is extremely high. It will take customers to get adjusted to this price. In India, what we always believe that high price, low price is certainly a matter, but up to a certain extent. Last year price was around 26,000. This year we have already, the average price is more than 30,000. But I feel that people are still waiting. But moment people will get accustomed to, get adjusted to this price, demand will return, but it may take few months. So some of the positives and negatives I put here. Positives is monsoon is certainly good. We have more than 5% more acreage happened this year. And we have also seen that Government of India has announced a 7th pay commission where 23.55% salary has been increased. And also we have a low CAD. And on the other side, on the negative side, media market is expecting the exit of Dr. Rajan. So how it will impact is highly speculative. But what is another story, that another factor that may come around the maturity of FCNR. But if we see the figure, it is not more than 25 points or $26 billion, and RBI has enough resource. Third is most important, that is expatriates income. That is, someone was talking earlier that money inflow has come down. So it is certainly it happened because 60% of the NRI remittance comes from the Gulf region, and we have very bad time that going on in the Gulf region, and expatriates income, NRI remittance are not happening. So overall, what we believe, the demand will return on fourth quarter of 2016 because of, and what I estimate that investment demand will be around, for the full half of 2016 should be 100 tons, and jewelry demand in anywhere between 280 and 300 tons. Our price look based on the current discount, it should be, average price should be 31,600, and price outlook based on no discount, it should be around 32,421. This price is adjusted with the rupee dollar movement against the movement of the LBMA price. Thank you very much.
Finally, Sudesh, can I ask you to say a few comments on the Indian silver market, please?
I just have two important slides here, and these two slides are going to speak a lot about what's the current status in the market. Before I get into the context, before I get into the slide, let me get into the context of how the whole Indian silver demand works. Indian silver demand is highly price sensitive and is largely attributed to its price volatility. There's tendency to hoard metal at rates perceived as trading at the bottom of the cycle, and there's a high level of destocking that happens at the higher price levels when the price rallies. This practice is common across the entire supply chain, from traders through to retailers and even consumers, though this can vary depending on the risk appetite of each individual. Retail investors and consumers tend not to buy silver purely as an investment vehicle, but for converting it into jewelry at a future date. Thus, the pent-up demand of last year was largely a result of accumulation that happened when the prices had moved on by more than 6%. Thus, indeed, in the hindsight, it would show that the Indian consumers were right on their call. Again, aside from the price volatility, demand for silver generally picks up during the wedding season, and is widely used in jewelry design and gifting of coins and articles. To put this in perspective, one of the wholesalers who's there in the forum, in the room here, he's a wholesaler of silver. He said, like in the Marwari community, in the month of June, there were about 5,000 weddings happen, and the average, or rather the minimum required silver in a mid-income household was 7 kgs. So just within a Marwari community with 7 kgs, you can just extrapolate it across India. That gives an idea about what's the total amount of silver that gets consumed, and this gives the base load demand in India. Thus, the demand from India is not necessarily dependent on the imports. It's the accumulation that would have happened over the period of time that gets converted into jewelry. That's what adds on to the demand, and not just the imports. And that brings in the relevance of this chart. The chart here is primarily a cumulative number. What you see here is the total supply in the last 3 decades to India, which is 93,000 tons. And 90,000 tons is the total supply. And addition to that, what you see here is the jewelry and silver, where that's plotted in the green. And that's the total accumulation. This investment side is about 15,000 tons is what our estimate has been accumulated. And on the jewelry side is about 46,000 tons. One might immediately question, why only 15,000 tons? Well, the reason is, as I said before, is the same consumer would have bought it at a lower price level. They would have exchanged the silver for jewelry at any point in time. So that's what increases the jewelry and the silverware demand. And thus you see that the red blocks or the investment demand, that's just about 15,000. And most interestingly, the price. This is the last 3 decades. The point of showing a last 3 decades is assuming, just for the sake of assumption, if somebody would have started accumulating for their daughter's wedding, which is when she grows to be 25. So the average price of accumulation from the age 1 of the daughter would have been at the rate of 16,500 rupees. So when the rate of accumulation was an average price at 16,500 rupees and the current price at 45,000 rupees, which is that 60% lower is the rate of accumulation, one would normally tend to go and exchange it for the new jewelry, or rather exchange the bars for jewelry. This is something that's bothered the trade across. The Indian silver market is getting to such deep discounts. To talk about this, let me start with what created this discount in the market. One, of course, was what I showed you before, which is a result of higher prices. India's silver import last year reached 7,954 tons. It was the third consecutive year of increase to a fresh record high. The more interesting fact is the last 3 years import, the cumulative of last 3 year import is equal to the previous 8 years import. Okay, so one could imagine the amount of silver that's lying in India, and or rather we had brought in so much of silver without a proper exit route, because from India it's difficult to export back the silver once it's been brought in, because there's a lot of regulatory issues on that front. Again, so let me get into more details about it. So the rise in volumes has also coincided with the increase in shipments by sea. This evidently has reduced the cost of sourcing the metal by at least 50%. With this happening at a time when prices were drifting lower. For information, last year the average price was down by around 15% compared to the annual average of 2014. Thus, in a declining price trend, both fabricators and investors found it lucrative to firstly ship in the metal, file the bill of entry, and then price the metal at their convenience. So, for now, even now, I've seen many of the wholesalers, many of the dealers still sitting on stocks at a tariff rate of 3,700 rupees, while the current prices are around 4,800. So that gives a clean idea of how much of silver was accumulated at lower rate. And last year, our estimate is that the average accumulation rate was at around 3,500 to 37,000. 3,700 was the average rate of accumulation by the dealers across. Fine. So in this process, under the current bull rally, the volume of silver held at Indian ports has started to accumulate, as some traders have not been willing to clear the shipments. Some, however, cleared the shipments by paying only the import tariff, but still did not price it. Then those who paid the import tariff then started selling silver at a discounted rate because there wasn't much of a demand coming into the market. So even when the price is at 4,800, what was cleared at 3,700 is being tried to be sold at 4,400 or 4,500. So adding further pressure was knowledge that many hundreds of tons were on the high seas en route to India. In essence, it was these factors that pushed the market into an oversupply and drove the market into a deep discount, which is currently about 50 cents. And unfortunately, the price rally in recent months has also caught many traders by surprise, because they did expect the price would rally, but they didn't expect that it would go beyond $18. And it was more like getting caught in the short positions. because after it crossed $18, there wasn't much of a demand that was actually coming to the market, and that's when the discounts started getting in. However, there were some who had accumulated silver for sake of averaging at a lower, averaging the purchase prices, because and I've heard of dealers and investors and even fabricators who had bought silver at 70,000 and 70,000, 50,000, and they started buying heavily at when it was around 34,000, 35,000. So, and thus for them it was a good strategy to rather destock when the prices rally. And as everyone, as Devajit indicated about the strike situation in the month of March, that also had a spillover effect on the silver jewelry market as well, because they were kind of giving a shoulder support to the gold jewelry market as well. This further added to the pressure and to the discounts. So, having given an idea of how the currently the Indian position is and in terms of stocks and the deep discounts in the market, do we see the discounts can change? I think that will be further discussed at the panel as we come out. So, but then I would like to more focus on what can be the future drivers. Last year, when I was here doing this on a similar presentation, I was very gung-ho about the industrial demand that can actually come into the market. A further investigation got to know that, for instance, I'll give you an example. Last year, silver nitrate imports were more than double that of the previous year, and that's happened after a sharp downturn in the Indian silver nitrate imports. So I was very curious, how could this happen? There isn't a sudden rise in demand or in terms of the glass industry or because the overall real estate market is down. How could this happen? What actually has been happening, unfortunately, is there's been a higher over invoicing of the silver nitrate that's been coming to India, and that's been and unfortunately that's the way the funds are getting transferred. So that's a hard situation that the Indian industrial fabricators are put into. And something similar is also on the silver strips that gets on the electrical contacts market, because electrical contact market is a huge market for India, at least on the consumption end. And I currently do not have any electrical contact manufacturer out here, but then the pricing, if you had to look at, the pricing was, wouldn't believe it was 70% more than what an electrical contact manufacturer in India would manufacture. And for same fine silver strip that is getting imported to India, and that has an additional CVD that gets paid. I'm really amazed at why all those things have never been pulled out within the Silver Industry Federation at all. Okay, the group. So I'm completely getting reversed on my opinion about the industrial demand that can actually happen in India, because it can happen only if there's a Make in India theme, it gets on a proper note, and also the companies follow a fully integrated model wherein they have managed to source it internally from India at a better rate within their own companies. So until that happens, I'm sorry, I don't look at the Indian industrial demand to pick up at all. Of course, we'll be importing a lot, something that's been happening on the solar panel end. India could actually supply close to 1,300 tons of can consume 1,300 tons of silver for the solar panel that's getting manufactured. But of course, we have been importing more from Taiwan and Russia of the silver paste or the silver powder, which gets converted to paste that gets imported to India. And this other category that has a huge scope is the silver varak. Varak, as you would have seen, are the sweet boxes that is placed in your room, and the spread on your peta silver, peta sweets. So I had been to Lucknow last month, and it was interesting to see how the silver varak is actually getting manufactured. It's the combination of meat, the fat is taken out separately, and then it's added with silver, and then it's beaten down manually into fine silver flakes, and that is what is actually getting added. So I'm sure many of those vegetarians would not be happy about this been happening. But there is a good demand that's actually coming out in the silver bharat on the industrial space. There's some very organized players who have gotten into high-end machineries which are manufacturing silver bharat, and that is what you would get into the I would say the Baba Pan. What you get there, you have the original bharat that gets into it. So, and there's a huge export market as well in same the bharat. Our estimate is close, at least about 110 to 120 tons is what the is the potential for the silver bharat market in India. And further we'll be discussing out of the panel.
So I have obviously a few questions I've been sort of burning to ask my fellow panelists, but of course please do contribute as well. But if I can start with you. You mentioned that as far as I understood anyway, perhaps the most important driver going forward is the real cost of carry in terms of the outlook for gold prices. And you also said that maybe the Fed will move to perhaps a 2 to 3% interest rate, that could be the new neutrality, give or take. What do you perceive would be maybe the turning point in terms of the real cost of carry that could sort of undermine gold at some point?
2 to 3% was the old neutrality. Now I think the latest estimate from the Fed was as low as 0.47%. So we don't think that 2-3% is going to happen anytime soon. But to answer your question, I certainly think anything over 150 basis points, 200 basis points in real terms would get capital moving out. I think a big factor would be that inventory costs would be expensive. And at this point, we have fairly hefty positions globally on the speculative side, and I think people are vaulting a lot of gold. If the opportunity cost of holding that supply became quite expensive, certainly if you had the funding costs rise, you would have, at least for a time, a lot of that metal start hitting the market, which I think on the margin could have a very material impact on the price. You would have the speculative money move first, and the technicians could take it a lot lower than we think. We don't think this is going to happen anytime soon, but it certainly continues to be a risk. In fact, our view is that the Fed is going to run the economy a lot hotter than it has in the past, and will keep the real interest rate environment a lot lower, as will other central banks, like the Central Bank of Japan. The ECB will simply serve as a sinkhole for the interest rate environment globally, and keep gold well bid for the foreseeable future.
On that note, and staying with you, Bart, if I may, I suppose playing a bit of devil's advocate, if that is the key driver for gold, do the physical gold markets matter?
I think physical markets do matter over the longer term. In the end, gold is a physical commodity, and if consumption outstrips demand for a prolonged period, you will have to have an equilibrium price adjustment. Either way, if supply jumps all of a sudden and demand isn't there, then prices will tend to move towards historically 90th percentile of the cost curve. Now, in the short run, they really haven't shown to matter all that much. Certainly this year we had a massive rally in gold. It was one of the best performing assets globally, maybe with the exception of zinc. We had a big move, 35% jump in ETF positioning. So to that extent, the physical market has moved. We had massive increases in the speculative interest to all-time highs, but markets like India, for example, markets like China are showing very little appetite. In fact, the traditional premium that we would like to expect, isn't a premium at all. It's the opposite of a premium. We're seeing discounts in many parts of the world. So there's a bit of a dichotomy where the investment, the pure investment, financially driven flows are positive, ETFs being among them, and the derivative markets. Meanwhile, other markets like this local market here isn't doing well at all. I think much of it has to do with currency adjustments, and here in India you have a lot of problems, a lot of issues, including the GST, all happen at the same time. As the US dollar is strengthening and as the local currency has shown weakness because of central banks' relative ease versus expectations of tightening in the Fed. But I think we're seeing a dichotomy now. So at this point, I wouldn't say that physical markets don't matter. I just think the investment markets are overpowering them. That won't hold indefinitely, but I think it will be state of affairs for the next, and I would say easily 6 months, if not longer.
Picking up on the physical markets, and Debajit, if I could turn to you. I thought your slide was very interesting where you listed the positive and negatives for the second half, and of course the monsoon featured quite prominently. In terms of the various factors, and picking up on your presentation as well, would you put the monsoon as the most important factor, or how would you weight it? I mean, compared to, as I said, we think that maybe gold prices will remain elevated. I mean, how does that play out, do you feel?
Observed the first level, the monsoon effect. Last 2 years, we do not have a good monsoon. But if you see the last 2 years, our demand, I feel there was nowhere less. So what actually happened this year in the first 6 months, we have a problem for many reasons. It is not about the excise. It is not about the jeweler strike. Price was also the issue. Suddenly price has gone up alarmingly, and people had no idea what was happening. So I feel that instead of blaming so many things, this is also the reason that we have a bad first half. Now second half, what I feel, what I observe, that 5% there is an increase in the acreage. So 5% acreage is definitely a big good news for us, and there is no resowing is happening. So on that front, we can imagine that there will be a better return on the agriculture. But we should not forget that there are some reports, the recent review, what is showing that there was a default on the tractors repaying in the last 2 quarters. So what the organization that estimated that it will take maybe another year to get adjusted to these loans that farmers taken in last 2 years for various reasons. So that is why I feel that monsoon is not a big impact, but yes, it should impact on the fourth quarter. And second thing is that 60% decrease in the NRI remittance from the Gulf region, that is one of the, I feel, the largest factor that will impact the gold demand this year. It is not a very small issue, because majority of these people, they belong to southern India, and you know southern India is the largest consumer of gold, whatever the region. So on that basis, my estimate was little, conservative. But I think in this market condition, 300 to 350, 400 tons is a good number for the 6 months, for next 6 months.
The contributes on the hike in the government salaries. Actually everyone has been speaking about the hike in government salary by 23% can create fresh demands. Actually look at this pay scale, or rather look at the split. What we observe is that the disposable income is actually not increasing at all. For them, this pay commission increase is the worst ever for the at least in the last 40 years. That the reason being, the disposable income has not increased. That is savings that is going to happen from the income that they are going to receive. The automatic deduction of towards savings, that is increased. So the only additional income that they're going to have is through the arrears, the last 6 months to 8 months arrears that they will be getting, the lump sum amount. That's what could potentially go for gold also. Just on that.
That's why you wanted to mean that the area that is, if that is going to be paid. It is already started from this month onwards. Areas. So that area is a big money that we'll get. I feel that, as I showed in the percentage of household income, some good percentage of money that will return certainly to gold.
Perhaps a question for both of you, and maybe this is just showing more my lack of understanding of the Indian market. When was there a last pay commission that was fed through into the market? And was it as significant as this one?
Actually, it would be difficult to relate it because the last pay commission, it was in 2008. And that was the time the demand had also picked up significantly. And because the price was rallying. So trying to correlate, the last pay commission was one of the best one. And that was a kind of consensus across the government employee sector, right from the peon to the senior most officers. So, and that is also the time when people are expecting higher prices in gold.
Actual scenario, see, central government employees will get the benefit of this pay commission instantly. They have started getting that. But usually as a practice, state government employees, they get little later. So it may take 6 months, 8 months more. So on that perspective, I don't feel the entire money will come to this in the fourth quarter. So so we have to see how would be the impact, I feel, in the first quarter or second quarter of the next year. That is the reality. State government employees do not get instantly.
But just picking up on your earlier comments about the second half picking up, so maybe stating the obvious, are you expecting the market to return to a premium? And if so, would that see bullion imports pick up, or would there simply be inventory destocking?
Maybe after I am expecting something, at least market will return to normal from October first week. So I am expecting that because a lot of things are there. Demand will increase from that month onwards. Lot of festivals are there, and of course the agriculture remittance, the agriculture from October onwards, farmers will return to market. So on that basis, I feel that market environment will certainly improve. And market, whether it will be a premium, maybe $2, $3, $5, it is very difficult to tell right now.
And my view on this is, I don't expect the market to get back to premium. No. I would see that the market, the discounts might reduce to maybe $3 or $4, or maybe it can, for a few days, can come back to parity. The reason, there's a lot of stock that is floating, which nobody has a clue. Okay. And until those gets absorbed into the market by the jewelers, until that gets absorbed and the demand, there's an equilibrium comes back to the market. So the market will be unstable till that point, at least on the discount side, will be very unstable. So the reason why the discount can reduce is because from October, by mid of September, or from October at least, the demand anyway will start picking up, the end consumption demand. So.
And taking a step back in the outlook again for precious or for gold specifically, in terms of some of the potential risks to that forecast, and you touched on this a little bit, we've seen a return of, I think, some producer hedging, a bit more this year. It's still very modest, of course. Do you see that developing? If you think back to the 1990s, it was pretty incredible, the volumes we saw, and that was one of the factors that saw prices depressed. Do you see any of those conditions returning at all?
No, is the short answer. First of all, among most of the miners that I talk to and our team at TD speaks to, there is very little appetite for full-blown hedging. So there isn't appetite among the corporates to begin with. That's issue number one. Issue number two, the bullion banks that traditionally would source the metal from central banks don't have the credit quality anymore. Their counterparty risk is simply too high, and it's very difficult to envision an environment in which you would have very aggressive hedging and sourcing of gold from bullion banks and one to another with such a low credit environment. So it would be very difficult to do that. So there's a credit issue, and there is an appetite issue on the part of on the miners and investors broadly. There isn't, after the fiascos we've seen in hedging in the past, the investment community is simply not prepared to allow corporates to do outright hedging, to the extent we've seen back in those times. However, I think there will be more than we've seen in the last several years. I think many people are realizing now that there is some accretive properties to hedging, meaning it's valuable to the share value, and certainly we've seen some corporates do that. Ones in particular that are maybe single unit companies with mining projects that need to be funded may want to hedge part of their production to make sure that they can cover their loans and don't become financially impaired. So I think that has been shown to be well accepted, and there is appetite for that, but it will not be the same as we've seen during that period.
Again, something else you touched on the supply side. Given where we've seen this rally in gold, does that mean from a sort of a mining perspective, I mean, given there were struggles in recent years, we sort of built up of debt and so on and so forth, has all that been forgotten? Is the potential for production cuts likely at all? Or will they be perhaps small, not even that meaningful?
I think we are in the progress of production cuts. Right now, they're not going to be so much conscious cuts per se. No miner is going to say, well, you know what, I have a profitable ore body, let me cut supply. That's not going to happen. But these, of course, are finite projects, and if you don't deploy capital, it is very likely, and it does happen, your mining capacity simply depletes. And as we all know, we've seen over the last few years billions and billions of dollars worth of write-downs, and we do not have anywhere near the projects that we've had 5-10 years ago in the pipeline. So new supply pipeline simply isn't there, and to the extent that these projects take 7 to 10 to 15 years to go from the planning stage to actual production, you are simply not going to have a big increase anytime soon. There's been a very material lack of investment over the last few years. There's simply very little evidence at this point to show that that has turned around. The junior mining space is in great difficulty. Canada, the TSX is the biggest market in the world for junior plays, and Vancouver as well. We, as an institution, are seeing many fewer participants on the junior side. And the way this market works, this industry works, you have exploration companies find ore bodies, partially develop them, de-risk them, and then more senior players will put real money and their expertise to bring them into production stage. This is not really happening very meaningfully right now, and there is really no appetite on the side of investors for that to happen. So I think over the longer term, yes, we will see production declines, and at the very least, probably fairly stable production profile. And these physical markets, as I've said, may not be all that relevant in the short to medium term, but over the longer term, you will see stresses develop. And if we have an interest environment that is conducive to keeping inventories locked in, these developing deficits will ultimately keep prices above previous equilibrium levels, I would say, over the longer run.
Sadish, coming to the Indian silver market, Debajit spoke about maybe having a stronger second half for gold. How do you see that playing out for silver? And just pick up on another point, I think in your presentation you said that the demand is not necessarily contingent on imports. Could you expand on what that means and what therefore you think imports may do over the rest of this year?
This has to be looked in the context of how the price is going to be. price is going to be over the next 6 months. We think the price can drop to about $18. $18 would bring it somewhere close to about 43,000 rupees in rupee terms. So a drop till there is what is going to create fresh demand in the market. So that could potentially pull out the excess stock which has not been cleared and they're still lying across the vault and where the bill of entry has not been filed. So close to about 900 tons could actually get cleared when the price actually drops to about $18. So that's where the demand is going to actually come in. So if in case the price doesn't drop and it continues with the rise to about 23.5, then it's all going to be given that the wedding season is going to come up, people are more likely to exchange their bars against jewelry or exchange of old jewelry for new. That's what is going to take place. With our forecast that the price can drop to $18, we think that the total imports this year can go up to about 3,000 to 3,200 tons, around that level. Currently, as of July, it's 2,027 tons.
And just pick up on the other slides about some of the main areas where we could see demand growth. I think you had industrial, and then jewellery, and then silverware. Is that how you rank them also in terms of importance?
Industrial, just ruled out as I was talking about it. There's a huge potential on the jewellery and the silverware. Silverware market specifically for the rise in income levels and in the silverware market there's generally not an exchange that generally happens. It's a fresh product that they normally buy. So that's one market that's set to grow. And here again, silverware market, there's been an increased demand for more than 90% purity based silver articles. It's been on a higher demand. Consumers have been directly demanding. It's going to add on the increased demand on that front. Additionally, on the silver jewelry as well, the 9 to 5 category is picking up really fast. There are more new fabricators in the market doing 9 to 5 jewelry as against just about 2 or 3 even 2 years back. So, because the increase in 9 to 5 category is again going to add on to the jewelry sales.
And just focusing on jewellery, we know in the gold market here that as well as being one of the prominent or one of the largest consumers of gold, India is one of the leading manufacturers of jewellery for export markets. How does that play out in silver? Is India also prominent from an export point of view?
Silver exports, there was a recent discussion on that, and there's been a higher demand, specifically from US, American markets for the silver jewelry made from India. Those are studded silver jewelry. So that's the segment that's seen a greater exports. And if you have to go by the simple numbers that's been published, unfortunately, there again there's some place that's been happening in the market where is being used for round tripping diamonds and synthetic diamonds, which are getting overvalued and getting exported. It's being studded with the silver jewelry. So I wouldn't go plainly with the numbers that was published. Rather, it's country-specific demand. That's going to help the Indian silver exports.
But the GST, when it comes in, could you just briefly summarise? I know it's very interesting myself and Bart, what the impact may be. Maybe it's just uncertainty going forward. Perhaps, I'm not sure if there's even a compare and contrast between the gold market and the silver market. But Debajit, if you want to start first.
For me, I feel that GST is certainly good for the market. Yes, personally I feel there should be decrease in the import duty before you implement the GST. 10% duty plus if you put, there are a lot of speculations in the market, 4%, 5%, 3%, whatever. So if you decrease the import duty to 5%, and if you can add even jewelry associations, they are telling it should not be more than 2%, the current excise plus 1 VAT. So if you can keep it within to 7 to 8%, the total taxation, I think it will be good for the industry. It will be good for the industry, for the consumer. From the consumer's perspective, because if you put more tax, consumers has to pay more. So on that perspective, certainly good. On the operations side, I feel that GST will certainly help the organized retailers. Those who are in the organized retail chains in India, they will certainly benefit. They will, because I am sure they will certainly look for expanding their business, expanding their market. And one such estimate made by few of the organized retailers, it is anywhere between, currently the organized retail share is 25% in the overall jewelry market, and they are expecting that it will increase to 45 to 50%. So, issue is what I am observing in the currently in India, that especially in the urban India, if it is tier 1, 2 or metros, whatever, the urban India, they are very much brand conscious now. The brand conscious happening. So on that perspective, if the branded jewelers, organized retailers, they can expand their business, they will certainly eat the market of the players who are still in the organized sector, and GST is a big opportunity for them.
I think most likely customs duty might be brought to zero and GST of 14%. So, and that's where the win-win situation is for the government as well as the trade community.
And then one question we've had from the audience, and I think you maybe touched on this as well already, but just to crystallise, are you expecting a reduction in the import duty over the next 6 months or so?
Reduction in the import duty?
For gold. Are you expecting sort of the bullion duty to come down?
They do understand that if they reduce the import duty, and with the speculation that the GST is going to be at about 14 or 16 percent, there's going to be a huge increase in imports, obviously. And that's one point. The second point, there's a lot of gold that is got exported on the replenishment scheme. And those who are exported, gold on the replenishment scheme, they are exported at buying gold from the local market at 10% duty. Now, if they have to get it back, and there's a 150 days window, so now they have to get it back and the duty has been reduced to 5%. They are a big loss. So I don't think they would allow the duty to be reduced.
Market cannot continue for a long. Certainly official bullion supply will certainly increase. So maybe it may take few months more, but I am expecting the bullion is coming through official sources. It will certainly increase. We cannot continue, we cannot tell that the unofficial market will continue to dominate. Because we should not forget that from this 10% duty was there since 2013. But in 2013, 14, 15, we never said this smugglers have taken away my market. We never said that. It happened this year. So I feel that even the 10% duty exists, official market will certainly recover and we will certainly see the more import.
So just a last question for Bart before I ask for your price forecasts. And I think it ties in anyway. So again, you've touched on this already in the presentation. So we've already seen, you mentioned the very strong gains in gold ETFs. I showed on my slide the strong gains in silver ETFs. Do you think that, say, both gold and silver ETFs can see strong gains over the rest of the year, or maybe there's a chance for liquidations? What do you think the outlook is there?
I think investors will continue to position themselves in physical instruments like ETFs. The reason I say that is because what we're seeing is equity markets that are being massively inflated by this low interest rate environment, and there is an increased amount of concern that we could have fairly robust corrections. Ditto for the bond market. We've seen very large increases in bond valuations because of the low interest rate environment. And to the extent that gold is a hedge or a safe haven instrument, we've seen much bigger value to these bond and equity markets. So in that sense, if you had $100 million in a fund, a bond and equity fund, now that's worth a lot more. So if you want to protect a particular portion of it, let's say 2%, now it's 2% of a much higher base. So, certainly I would think, unless things change on the macroeconomic side, we will continue to see flows into the ETFs. Maybe not as violent of an increase as we've seen, 35% this year, but I think a steady burn higher. The price forecast, I have it written here. For gold for 2016, 1276 and 1268 for 2017. So lower, but not a red.
Just to share mine as the chair. So our gold forecast levels focus for this year's average of 1260, which will be a rise of 9% for the full year. We're probably a little more bullish on gold for 2017. We're looking at a 6% rise to about the 1340 level. And then for silver, about 1730 this year, which will be a 10% rise. And then we are expecting further upside, no fireworks, but further upside. So we're looking at a price of, give or take, about $19 for an annual average for 2017. Debaji, I know you mentioned gold. Could you just recap on your forecast, please, for gold for this year or next year?
This year, that's what I have given here. I am expecting with discount around 31,500 to 31,400, and without discount, provided that everything remain constant, no decrease in duty, no decrease in no big decrease in the rupee dollar rate. So, and with no discount, it is around 32,300, 32,400 for this year. I am expecting the London price will remain around $1,340 per ounce average for next till December 31. Based on that, we calculated what I projected here. Obviously, in the next year, I am expecting price will certainly move more higher in London. In India, we have to see how market forces, what they say, whether it's a decrease in duty, at what rate GST is coming, everything we have to take it into consideration.
And Satish, I know you touched on your low for silver in the coming months, but could you just crystallise your forecast as well, please?
In rupee terms, because you're covered in dollar terms, rather focus on rupee terms. Yes, I'm saying price to come at least about 29,000. Price to correct to 29,000, and that will be triggered by possibly a stronger rupee, and so gold prices may not fall much. It might fall to about $1,270 or $1,280, but then there's potential that rupee can be stronger. The risk factors that is there currently in terms of the redemption pressure is going to be easily managed, I feel, because the oil prices are lower.
Really a question for the guys on my right-hand side of the panel, no offence to the guys on the left here. I was just wondering your thoughts about the impact of, and maybe this was covered earlier in the earlier session, when I couldn't understand what was being said. Your thoughts about any fear about the gold monetisation scheme by the average Indian, and whether that's actually having an impact on it. Because look, as we all know, gold is in the psyche of every Indian to go buy it as a normal store of wealth or whatever. But do you think that there's a possibility that the decline in the actual purchasing of gold instruments here, or gold, physical gold, jewellery or whatever, is actually partially a result of people being afraid that the actual GMS is the government trying to get their hands on the gold, and that if they go and buy more, then it's going to end up in the hands of the government now. So there's a period of just trying to understand what the scheme actually means, because we see this backed on with speakers over the last couple of days saying that the scheme hasn't gone as well as people thought it would go. And so maybe it's not quite well understood or quite well designed yet. Because I mean, there's all sorts of speculation on why things are, why the market's down, but some of them don't seem to be aligned with historics. I mean, you're saying that gold price, gold purchasing is down because of the import duties. But we had a jeweller this morning saying that the actual demand is the worst he's ever seen in 32 years, though this is not the highest price we've ever seen in 32 years. Several years back it was far higher, obviously. So I'm just wondering, is there a fear there that the gold is actually going to be snatched from the people who are actually buying this gold?
I think in terms of this year, and I'll always defer to my colleague Chirag in the audience, who looks after the market much better than I do, for India. But one of the factors is in terms of when we think of the strike that we had, I for one was thinking, well, there was a sufficient gap between the strike ending and Akshaya Tritiya happening in May, but that didn't happen. And I think one of the factors that we saw is that the gold price in rupee terms pre and then post-strike was about, I think, about a 10% rise. So there was like a sticker price shock. In other words, normally consumers in India, unless you've got huge volatility, consumers in India can adjust to that within certain parameters, of course. But when the market was essentially closed, apart from a few backdoor purchases, the consumers didn't have that ability to adjust. And so I think that's been one of the key reasons why you've had the market remaining so weak. But I take your point about the imports, the import duty rather. If we think that at the beginning of last year, when, if I get my timing right, we still had 80-20 in force at the beginning of last year. You had premiums over $100 in India. Demand didn't collapse then. So these prices get passed along to the consumer. So I don't think that the duty being where it is now is a factor in that sense. I think my own personal view is that it's more of a factor in terms of the official versus the unofficial coming into the country more than anything else. And in terms of the various schemes that the government has introduced, that I think you've also touched on as well, is that a factor? I think by and large, their success has been quite gentle. And I think there's still a learning about how they can actually do something. Because the goal that's been held by the public is really quite significant. And of course, as you know, the volumes that have been tapped into have been, at best, modest. So I think that is, a separate issue from demand being so excessively weak this year so far. And as Debajit spoke about as earlier, the monsoon should be good and allowing for debts that need to be paid off. There should be a much stronger second half. Whether it returns to premiums, I would have thought so, but frankly, who knows? But I think we're still going to have a much better second half with these same policies in place, and even if the government doesn't change the import duty, I would suggest to you.
Yeah, the gold price, goes up and down, and it has for years. And my point is, only a few years ago it was $1,900 for a period, and then it was 2012, 2013, people called the end of gold when it hit $1,500, right? So it was much higher a couple of years ago, only for a short amount of time. Then saying that this year is the worst it's ever been in terms of the appetite for something that is significantly lower than it was a few years ago. In the background, general economy, you guys in New York might see it differently, but most industries around the world are far worse off than they were a couple of years ago. So I think that, the guys, say on my right, the guys whose opinion I say no offence, would really like to know, because they're talking to a lot of Indians locally here, is when I was told about the GMS last year, the words amnesty were used in the discussion about GMS. Now, whether that's true or not, it came to me that this is a system which is going to be brilliant. I think that if it's done right, it could be the best thing for India and for the gold industry. I really do believe that. But my first impression, and obviously as an uneducated foreigner into the system, was that this is a system here that the government may be able to come in there and take the gold. Now, obviously, a lot of the gold trading is going on by people turning up to jewellers at a desk there, handing over their gold or buying gold. So it's a very easy system where you could put a policeman in a jeweller and say, well, okay, you're a holder of gold now, we're going to track you. Now, there's numbers have been slated that 70% of the gold is being held in the hands of rural people who don't look at any price forecasting. Probably half of them don't even have a TV, I would have thought. And they don't care about the pricing. Historic has shown that they don't care about pricing. If they were buying more gold when it was $1,500 and $1,900 than they are now at $1,300. But they hold gold because they're actually afraid of the monetary system or the banking system or the government because they don't understand it. So if you go out there and say, we as a government want to buy all the gold, and you've got somebody in a paddock who's, sure, they're worse off because of monsoon and because of the general economy and so on, sitting there saying, well, if I buy gold, the government is going to know I've got gold because I'm just a little guy and the government is this great empowering force here that I'm actually afraid of at the moment. So I'm going to hold off buying gold until another time when I can get gold and they don't know that I've got it because I normally go to a source. So I'm just wondering whether that's ever been brought up with people just confused about that system or not, because as a novice to the industry here, my first impression is that is the government coming in and wanting to take hold of that great asset which is Indian gold.
Helping the balance of payments, although of course the pressure there is not as great as it has been. I've got to say that when we travel around, and as a research house we are not in a sense Mumbai centric. We do get out into the agricultural and we speak to the jewellers there and we try and understand the drivers. I think you have to, because to go to your point, about 2/3 of Indian gold demand, of jewellery demand, is in the rural agricultural communities. So it's absolutely pivotal. And you've also seen the government pushing with its banking the unbanked as they try and move into that sector. So these are all sort of factors that are playing out. But in all honesty, we haven't heard about the uncertainty and mistrust. But I think what we could do maybe is take this afterwards and we'll have maybe a deeper conversation if you've got some time. Starting
with our first speaker, this presenter this afternoon, Mr. Bart Melek. Big thank you, Mr. Satish Nambiar. Bulletins, Mr. Devajit Saha. I would request Mr. Shankar Sen of Senko Gold to please join us on the stage to present a memento to Mr. Philip Newman.